How to trade CFDs successfully. The rise of CFDs and spread betting over the last decade has naturally impacted on the amount of trading in physical shares using a traditional stockbroker. There is no doubt that the internet has altered the share trading process to the benefit of private clients in terms of cost and access to information in markets, and with broadband and efficient streaming, this really is a boost for those looking to capture real-time movements using online trading. The first part of this paper discusses why CFDs and spread bets are now so popular, and then the subtle differences between the two will be explained. In the old days, what now looks a very cumbersome system involved phone-based dealing, with the client having to wait for a dealing report from the broker, and this would be followed up with a paper-based settlement and certification system. The introduction of nominee accounts and the CREST settlement system was a great step forward, and in terms of deals carried out for investment rather than trading, the system works well. First, there is no stamp duty to pay under current tax laws, so there is an immediate pickup of 0.5% on all UK-based trades. The reason is simply that with a CFD, the client is contracting to pay the difference between the opening and closing prices of the position taken, essentially the profit or loss. Delivery never takes place, and there is no time limit on the CFD, therefore there is no stamp duty. Spread bets are treated as bets and are not currently subject to duty likewise. Second, clients have the ability to take long or short positions on the underlying share, commodity, or index. This is an option that many traditional stockbrokers still prohibit, and is useful both as a speculation and for hedging purposes. CFDs offer a simple and effective way to protect against a potential fall in the stocks market, or for that matter any instrument, without having to sell shares in a portfolio and then buy them back. Third, traders can utilize generous margin rates, which by using leverage enable large position sizes to be opened using a relatively small amount of deposit. It goes without saying that there is an associated risk which mirrors the amount of leverage, but for experienced traders this to some extent bears some similarity to traditional physical trading for extended settlement. For CFD traders, margin rates of as low as 1% are available, which again is very attractive for hedging purposes. For share trading, it is usual for clients to place funds on margin, but positions have to be closed within the trading settlement period, or the full cost of the purchase has to be made. The client usually pays a premium for not having to settle for up to 25 working days. Again, this option is not allowed universally by brokers, and CFDs solve this problem as they have no time limit, which makes them far more flexible. Spread bets can be taken out with a wide range of expiry dates, so again it increases the choice for clients. With these benefits and the undoubted cost advantages, the natural question is why clients would wish to use a traditional stockbroker. The answer, of course, lies in the added value services offered by a broker, which include portfolio analysis and management advice on collective investments, taxation, and other financial products. For clients seeking perhaps a longer-term perspective on investments and for buying and selling shares on a longer-term view, stockbrokers have an important role to play. Buying shares outright also gives clients the benefit of shareholder voting rights, which is not the case for CFDs and spread bet positions, although holders of long CFD positions do receive corporate dividends, and short CFD positions are debited with dividend payments on the ex-dividend date. It is for shorter-term trading and longer-term hedging that CFDs and spread bets have a clear edge, and they are both beneficial for those who wish to go it alone in terms of costs. This benefit can be quantified in terms of the length of time each trade is open. With CFDs, the additional cost of holding a long CFD position over a traditional purchase is only the interest cost. The interest charged on a long CFD is usually at a premium to LIBOR, typically LIBOR plus 2%, but it should be noted that if a client takes a short position, then interest is actually credited to the CFD position at a comparative discount to LIBOR. The amount the client lodges by way of margin is held to secure the performance of the contract and is not available to be set off against the contract value. Conversely, a traditional share purchase incurs stamp duty at 0.5%. The crossover will occur at the time that the interest charged on a long CFD matches the saving made against stamp duty, and this point is usually reached on or around 28 days after the position is opened. Consequently, for trades outstanding for less than this period, it is economically more viable to trade the CFD rather than the underlying stock working on current interest rates. For those going short of a stock or index, there are clear benefits, as interest is received each day while the position is open, so time is not a factor. The terminology is slightly different for CFDs and spread bets, but both offer the same degree of leverage and potential risk-reward for online trading. If a client wishes to open a CFD position, this is quoted in the same way as if a normal share purchase sale was being made, that is by 1,000 Lloyd's TSB CFDs. With spread betting, one is technically betting on the price movement of a share, index, commodity, or whatever, measured in pounds per point of movement. So the equivalent trade here would be by Lloyd's TSB at £10 a point, but the exposure is essentially the same. In both cases, you simply buy if you think that the price is set to rise, or vice versa. In spread bets, all profits are free from UK capital gains and income tax, which is not currently the case for CFDs. The other main difference is that for spread bet long positions there is no daily funding, but as each bet has a defined expiry date, the interest cost to the broker is built into the spread in the same way as a futures price might be constructed. In terms of use, CFDs have the edge for stocks market trading, accounting for 40% of LSE volumes, and many investment banks tend to use CFDs simply because they tend to track the underlying price more than spread bets. There is no question that CFDs and spread bets have revolutionized short-term and online trading if one does not aim to hold any long position for more than a month, and they are valuable for longer-term hedging.